Right now, as you're watching this, there's a family somewhere in Australia packing up their rental because the landlord just hiked the rent by $150 a week. There's a young couple in Sydney who have been saving for 6 years and they're still not even close to a deposit. And there's a tradie in Brisbane earning 6 figures who just got told he can't afford the mortgage on a 3-bedroom house. This is Australia in 2026, and something has gone seriously wrong with housing in this country. Let me break it down so it actually makes sense. The median house price across Australia's capital cities has now crossed $1 million. In Sydney, the median sits around $1.62 million. Even in cities that used to be considered affordable, like Brisbane and Adelaide, prices have surged by double digits over the past 2 years. The national residential property market has passed $12 trillion in total value. That number is almost impossible to wrap your head around. It's bigger than the GDP of every country on the planet except the US and China. So how did we get here? It starts with supply. Australia simply does not build enough homes. The federal government set a target under the National Housing Accord to build 1.2 million new homes between mid-2024 and mid-2029. Sounds promising, right? Here's the problem. The plan is already a year behind schedule. Independent forecasts say we'll fall at least 262,000 homes short of that target. In the first year alone, we started 60,960 fewer homes than needed. Meanwhile, population growth keeps accelerating. Australia's population grew by 423,600 people in the 12 months to September 2025, reaching 27.7 million. Net permanent and long-term arrivals hit a record 480,520. Every single one of those people needs somewhere to live. But in 2025, the net increase in housing stock was just 165,500 homes. Do the maths. The demand is crushing the supply. Now, here's a detail most people miss. The biggest cost driver in housing isn't actually construction. It's land. A report from the Housing Industry Association found that residential land prices have risen more than 500% since the year 2000. Construction costs went up about 150% over the same period. So when politicians talk about cutting red tape for builders, they're only addressing a fraction of the problem. The real bottleneck is the dirt underneath the house. And then there's a whole layer of tax policy that quietly tilts the playing field. You've probably heard the terms negative gearing and capital gains tax discount thrown around in the news. Here's why they matter. Negative gearing allows property investors to deduct their rental losses against their taxable income. And the capital gains tax discount cuts the tax on property profits in half, as long as you've held the asset for more than a year. Together, these two policies make investment property incredibly attractive from a tax perspective. The result is that investors are competing directly with first home buyers, and they have a structural advantage. Investor lending is up 23.6% over the past year alone. The government is now examining potential limits to negative gearing, but no firm changes have been announced. Until these settings shift, the system continues to reward speculation over home ownership. And the rental market is just as brutal. The national vacancy rate fell to 1.1% in February 2026. To put that in perspective, a healthy rental market sits around 3%. At 1.1%, renters are competing against dozens of other applicants for every listing. Average monthly rents in major cities are now pushing towards $2,600. Tenants are spending a record 33.4% of their income just on rent. That's well above the 30% threshold that experts consider housing stress. And 43% of low-income renters receiving government assistance are still in rental stress. What about buying? The average home loan deposit in Australia in 2026 sits around $173,000. The average full-time income is about $110,000 a year. A single buyer in Sydney would need to earn roughly $200,000 a year to service a mortgage. In Brisbane, you'd need $166,000. In Melbourne, $145,000. These aren't luxury properties. These are average homes. For young Australians aged 25 to 29, home ownership has dropped from 50% in 1971 to just 36%. For 30 to 34-year-olds, it's gone from 64% down to 50%. The human cost is staggering. Over 122,000 Australians are experiencing homelessness. Up to 3.2 million people are at risk of losing their home from just one life shock, whether that's a rent increase, a job loss, or an unexpected bill. The proportion of renters stuck in housing stress for 2 or more years jumped from 48% in 2022 to 60% in 2023, and it's only gotten worse since. On top of that, more than 254,000 households are sitting on social housing wait lists right now. In New South Wales alone, over 67,000 households are waiting. These aren't just numbers on a spreadsheet. These are people sleeping in cars, couch surfing, or staying in situations they'd leave tomorrow if they had anywhere else to go. Now, here's what I really want you to take away from this. This crisis didn't happen overnight. It's the result of decades of policy choices, zoning restrictions, underinvestment in social housing, tax structures that reward property speculation, and a planning system that makes it painfully slow to get new homes approved and built. So what can you actually do about it? First, understand that waiting for the market to crash is not a strategy. Prices rose 8.8% in 2025. They're forecast to rise another 5 to 7% in 2026. Demand is strong. Migration keeps fueling population growth, and supply isn't catching up. If you're saving for a home, get serious about your strategy. The government expanded the 5% deposit scheme in October 2025, so every first home buyer can now purchase with just a 5% deposit and no lender's mortgage insurance. There are no more income caps and no wait lists for spots. That alone could save you years of saving time. Look into it. Explore regional areas where your dollar stretches further. If buying feels impossible right now, focus on building your financial position. Increase your income, reduce your debts, and invest in assets that grow. This housing crisis isn't just a policy problem. It's a personal finance problem. And the way you respond to it right now will shape the next 10 to 20 years of your financial life. If this video helped you see the situation more clearly, hit that subscribe button and turn on notifications. Thanks for watching, and I'll see you in the next one.